Greetings, everyone. This is John A.G. speaking. It's Friday, February 6th, 2026, and I need your attention for the coming minutes because the recent silver market movement represents the type of shift that transforms portfolios, eliminates uncertain investors, and propels mining stocks into explosive territory. At the close of last week's trading, silver experienced more than a minor decline. It plummeted dramatically. This severe single-session crash felt like sudden ground loss. Gold also suffered, experiencing its own decline. Almost immediately afterward, silver rebounded and resumed its upward trajectory. Those who weren't paying attention missed this turning point. Those who acted on fear likely sold at the lowest point. If you're still here watching, you're already positioned better than most. Before continuing, I need to address something my data consistently shows. Many regular viewers haven't yet subscribed. If you find value in this direct market analysis, please subscribe now and leave a brief comment. Even just John A.G. works. This signals platform algorithms to support the content and helps combat the imitation problem plaguing this space. Let's examine what happened. Silver had been experiencing an extraordinary rally. Not a typical bull run, but an overheated surge. Less than 12 months ago, silver traded in the mid-20s. Then it exploded upwards so rapidly that even seasoned bulls questioned the sustainability. It didn't stop at 40, 60, or 80. It reached triple digits, capturing global attention. However, when markets run this intensely for extended periods, they build pressure. This pressure must eventually release, either gradually or forcefully. That Friday's action appeared forceful. Silver experienced one of its most dramatic single-day drops in recent memory. And while painful to watch, such moves don't necessarily signal the end. Often, they simply clear excess leverage, preparing the market for its next advance. What triggered this? First, the obvious factor. The rally was overstretched. During relentless price increases, many late participants enter, not due to fundamental understanding, but because rising charts attract them. This accumulates leverage, margin trading, speculative capital, and momentum-driven investments. When fast money becomes anxious, everyone rushes toward the same narrow exit simultaneously. Second, market mechanics played a role. When exchanges increase margin requirements, it effectively intensifies gravitational pressure. Traders comfortable yesterday suddenly need additional collateral today. Some can provide it. Many cannot, forcing them to sell, not by choice, but by necessity. Third, the macroeconomic environment shifted. When messaging trends toward dollar strength and hawkish policy, risk assets typically weaken. Silver, despite its upside potential, notoriously amplifies downside movements. It resembles a sports car, exhilarating on smooth roads, frightening on treacherous terrain. There's another dimension many are questioning that deserves honest discussion. Numerous long-term silver observers believe the paper market operates with inherent bias. They maintain the system naturally opposes precious metals because metals expose fiat currency vulnerabilities. Regardless of your position on this, consider this. Silver markets have displayed unusual behavior historically. Reports suggest that day's movement exceeded supposed intraday circuit breakers designed to halt trading. If accurate, this raises important questions. Was this purely technical correction and leverage unwinding, or was intentional pressure applied during thin liquidity? I'd like your perspective in the comments. Do you believe the drop resulted primarily from technical factors and leverage clearing, or do you suspect deliberate paper market manipulation? Be respectful but honest. I read every comment. Here's what keeps silver compelling as an ongoing narrative. Even after this sharp decline, underlying demand hasn't disappeared. Silver isn't merely speculative trading, it's industrially essential. It's a critical component with increasing annual consumption across solar energy, electronics, automotive, defense, and medical applications. As global complexity increases, silver consumption accelerates while most remain unaware. This brings me to a harsh reality. Supply doesn't expand quickly. Mine development requires years. Permitting takes time. Capital deployment takes time. Skilled workforce development takes time. When supply pipelines are constrained, you cannot instantly create new supply. Therefore, when silver rallies, it can exceed expectations. It can punish late chasers, then it can surge again once weak hands exit. This explains why volatility shouldn't be confused with market death. Volatility is simply the cost of participation. Let's address the question circulating widely. Will we see triple-digit silver again this year? Many considered triple digits fantasy. Then, it materialized faster than anticipated. Now, following this shock, the market attempts its usual trick, convincing you it was anomalous, that the opportunity has closed. However, if structural demand remains genuine, if industrial purchasers continue bidding, and if supply stays constrained, revisiting those levels doesn't require magic, just time, persistence, and buyers unable to substitute silver. Consider this underappreciated point. Industrial purchasers don't respond to emotions. They prioritize continuity. When factories require silver, they require silver. Production line shutdowns cost more than higher per ounce prices. This creates floor-level buying behavior most underestimate until it's too late. Now, I'll address the aspect that could transform this from interesting to transformative, and it doesn't concern metal prices directly. It's mining equities. This is where many investors err. They focus on silver charts, celebrating gains and lamenting pullbacks, never calculating how price movements affect miner cash flows. Let's examine this plainly. Consider a miner with $20 all-in production costs per ounce. At $25 silver, they generated approximately $5 margin per ounce. Producing 10 million ounces yielded roughly $50 million operating margin. Respectable, but not extraordinary. Now consider $85 silver. That same miner no longer generates $50 million. They're generating approximately $650 million in margin with stable costs. This isn't incremental improvement, it's transformational. This explains why miners can experience explosive growth. Even if silver doesn't continue climbing, sustained elevated prices allow financial statements to reflect current reality. Here's the challenge. Wall Street often analyzes retrospectively. Analysts build models using outdated price assumptions, anchoring to previous periods and historical normal silver prices that no longer exist. Consequently, miners can remain undervalued longer than expected until earnings force reality recognition. The setup is straightforward yet powerful. If metal prices have moved while equities haven't fully reflected this, the catch-up movement can be dramatic. Let me be responsible here. I'm not recommending purchases. I'm identifying what to monitor. Watch upcoming earnings releases, watch guidance updates, watch management discussion of costs, free cash flow, and expansion plans. Markets will reprice winners. However, exercise caution. Not every company with silver in its name operates legitimate silver businesses. Some are explorers without production. Some are lifestyle operations. Some are dilution vehicles. During hot cycles, all talk boldly. During cold cycles, only genuine operators survive. If you're considering miners, prioritize quality and sustainability. Real assets, competent management, actual cash flow, or clear pathways to it. Here's an overlooked insight. The most significant miner moves often don't occur when silver makes headlines. They occur when the crowd believes the move has concluded. Then earnings reveal how mistaken the crowd was. Therefore, remain vigilant. Returning to markets. Gold deserves mention as the precious metals complex leader. When gold moves, the entire sector receives permission to reprice. Something's happening at ground level not always visible in charts. When people queue outside bullion dealers, that's not trivial, it's signaling. When buyers arrive early, get turned away, and return, that's not top behavior in under-owned assets. That's recognition behavior, indicating public realization that paper promises differ from physical assets. There's a regional dimension. In many Asian markets, precious metals hold cultural significance. In Western markets, people were distracted by equities, real estate, and easy credit. But when vulnerabilities emerge, people return to traditional anchors. The tailwind for gold and silver isn't single headlines. It's accumulating stress, debt, deficits, policy uncertainty, geopolitical tensions, and political reflexes toward printing, cutting, and patching, rather than solving problems. When the next recessionary concern emerges, policymakers historically reach for familiar tools. Lower rates, stimulus, expanded liquidity. These tools erode purchasing power over time, which is why gold and silver persistently return as insurance. Now, let me discuss a practical situation without commercial intent. There's a company I've been monitoring that controls a significant high-grade district in a secure jurisdiction. They possess former producing mines, extensive land holdings, and aggressive drilling programs. They're currently merging with another company that already generates cash flow from operating mines plus additional growth projects. Why does this matter? Because scale changes everything. Larger companies attract institutional capital. Institutional capital brings liquidity. Liquidity drives valuation re-rating. During bull markets, re-rating can outpace actual drilling progress. A shareholder vote is scheduled for mid-March. If approved, the combined entity could effectively complete by late March. While nothing is guaranteed, it represents a catalyst timeline. Markets respond to timelines. The vision involves creating a platform combining production, development, and exploration. Multiple projects rather than singular focus. This mix enables internal growth funding rather than constant market dilution. On the exploration front, recent results from a vein corridor show extensions, tighter continuity, and indications that two major zones might connect. While technical, the simple translation is, the mineralized footprint appears to be expanding beyond historical boundaries. In straightforward terms, the district may be larger than currently priced. During silver bull cycles, larger than expected isn't trivial, it generates headlines. They also have another gold-heavy target several kilometers away with results anticipated soon. Meanwhile, the partner company has been drilling a high-grade gold system at a former producer site, also expecting results shortly. You have a near-term catalyst sequence: drilling, voting, transaction closing, earnings, then additional drilling. This is how resource stocks advance, not linearly, but in bursts. The bursts create lasting impressions. However, here's the uncomfortable reality. It's volatile. If you cannot tolerate losing days, this sector will overwhelm you. It's inherently volatile with 15% gains and 12% losses. Emotional responses make you exit liquidity for disciplined investors. The genuine advantage isn't predicting every movement. It's understanding cycles and positioning with patience. Let me address long-term followers directly. Many of you survived a decade when precious metals seemed dormant. You witnessed failed rallies and disappointing miners. You watched hype cycles come and go. That experience conditions you to expect pain. When you observe massive down days, your instinct screams, "Here we go again." But this cycle differs from previous ones. When corrections get rapidly absorbed, it signals something. Genuine demand exists. It indicates the market has entered a different phase where pullbacks don't persist indefinitely. They get absorbed. Then price seeks higher ground. Think strategically, not speculatively. Where's the demand? Where's the supply? Where's the leverage? Where's the fear? Where's the forced selling? Because forced selling creates mispricing. It's the opportunity. Here's my second engagement question. If choosing one, would you prefer physical metal ownership or a quality miner portfolio for leverage, and why? Share your answer in comments. I want to understand this community's thinking. Also, if any viewers are already succeeding in this space, perhaps catching the move early or converting a small position into something substantial, share your success story in comments. Not to boast, but to educate. People need to see what's achievable in your approach, so community morale remains strong. By the time you're watching, there's already a members-only video available pulling together recent moves, key levels, and deeper analysis. If you want comprehensive coverage and wish to support the channel directly, join the membership. This also shows me who's following closely. Let me conclude with a concise summary because I want you leaving with clarity, not confusion. 1, that sharp silver correction was historically rapid, but followed a historic rally. Context matters. 2, technical overextension, margin mechanics, and macro conditions can combine for waterfall declines. This doesn't automatically terminate bull markets. Often, it resets them. 3, the manipulation discussion exists for valid reasons, but even disregarding it completely, the structural demand narrative remains foundational. 4, miners represent leverage, and leverage is mathematical, not emotional. When the spread between price and production cost widens, cash flow explodes. Markets eventually reprice cash flow. 5, the greatest opportunity often emerges when crowds are confused, right after the shock, before the next leg becomes obvious. Here's what I want you to do now, in sequence. Subscribe, 1 click. If you want the complete premium recap, check the members-only video already live and consider joining membership. Then comment R, plus your answers to my questions, because your comments fuel the algorithm, signaling this content deserves amplification. Let me be absolutely clear. I'm not here for entertainment. I'm here preventing you from making 2 classic silver mistakes. First mistake, chasing euphoria. Second mistake, abandoning the narrative when volatility emerges. Both mistakes cost money. Both are avoidable. Both are happening right now across the entire market. When that Friday sell-off hit, you could sense it. Screens turned red, charts went vertical downward. Social media became a panic room. Some screamed manipulation, others screamed bubble. Most did the worst possible thing, reacting without strategy. That's why I'm methodically walking you through this like adults, because this is how you build market advantage that consumes emotional traders. Here's a mental exercise. Imagine you're a manufacturer requiring daily silver. You're not a trader. You don't care about status. You care about delivery schedules, contracts, and operational continuity. Now imagine prices go parabolic, then crash in a day, then rebound. What do? You don't emotionally abandon the metal. You secure supply. You establish relationships. You ensure you're not at the back of the line when everyone else awakens. That's the quiet force beneath charts most underestimate. This brings up something insufficiently discussed. Silver contains multiple internal markets. There's the paper market with second-by-second price updates. There's the futures market where leverage lives. There's the physical market where actual buyers want real bars and coins. Then there's the industrial market where silver gets consumed permanently. These layers don't always move in perfect synchronization. Sometimes charts indicate one thing, while street-level activity indicates another. The gap between these realities contains both opportunity and danger. If you visited dealers during volatile periods, you understand. One shop quotes attractively low prices because they're overloaded. Another quotes seemingly insane prices because they're sold out. That spread is informational. It reveals where stress exists. During wild periods, that stress becomes the underlying narrative. You might wonder, John, is this the end? I understand why you ask. A 26% single-day drop feels catastrophic, but examine context. The preceding rally was extraordinary. When markets climb for months, they create ladders, Corrections kick people off ladders. Then, if underlying demand is genuine, ladders get rebuilt, often higher. That's why I think in stages. Stage 1 is disbelief. Only early contrarians pay attention while everyone else mocks them. Stage 2 is the wall of worry. Trends are upward, but markets punish with sharp corrections, false signals, and frightening headlines. Most quit here, even though major moves remain ahead. Stage 3 is mania. When your barber asks about silver, your relatives start silver group chats, and people who've never examined balance sheets buy anything with mining logos. This stage is enjoyable, but requires discipline. Currently, based on correction speed and bounce velocity, we appear to be in Stage 2 environment. Corrections get purchased, fear spikes, then bids emerge. The next few weeks are crucial. They'll reveal whether the bounce is temporary or a resumption. Here's the compelling part. If it's a resumption, the next minor movement could exceed silver's movement itself. Why? Because miners aren't priced for $85 silver. Many mining stocks still reflect $35, $40 silver pricing because models lag and institutions move slowly. They don't revalue overnight. They await confirmation, earnings, updated guidance, and CFO statements confirming, yes, margins expanded. Yes, cash balances grew. Yes, we can fund growth without dilution. When that confirmation arrives, it can trigger 3 simultaneous events. 1, analysts raise price targets. 2, funds mandated to buy profitable companies begin purchasing Owosona. 3, ETFs and indexes increase exposure as market capitalizations expand. Let's make this more concrete with a second scenario. Assume silver doesn't immediately reach $115 again. Assume it remains between $70 and $90 for months. That range would still be ideal for efficient producers. Why? Because costs don't jump 200% overnight. Energy, labor, reagents, yes, they move, but not like prices. So profit margins stay wide. Wide margins create cash. Cash creates options. Debt reduction, share buybacks, restarting previously uneconomic projects, dividend payments attracting new investor classes, and acquisitions. During bull cycles, strong operators acquire weaker ones, quality assets get consolidated, districts get unified, and markets reward consolidators because scale reduces risk. Even if silver moves sideways, miners can still trend upward because markets reprice their futures, not their pasts. Now, a warning, leverage cuts both ways. Exploration companies can surge 30% on a drill hole announcement. That sounds exciting, but they can also drop 30% on financing news. They can dilute shareholders. They can miss targets. They can encounter permitting delays. They can burn cash while markets lose interest. That's why I repeatedly emphasize quality. Quality means strong balance sheet, adequate cash, competent management, clear strategy, and assets in stable jurisdictions. It also means understanding share count. If a company doubles outstanding shares annually, you can be correct about metals and still lose money through dilution. Let me return to that combined company narrative mentioned earlier because it directly connects to momentum and catalysts. Mergers matter in this sector simply because investors prefer clear narratives. Single project stories carry risk. One permit, one drill program, one setback, and you're done. Platform stories spread risk. They also attract larger investors requiring liquidity and scale. The platform I'm discussing has 4 distinct assets, 1 currently producing, 1 near production, and 2 in development and exploration. This mix matters because it creates a pipeline. Pipelines maintain attention. Attention supports valuation. The vote timing matters because it establishes a calendar. Calendar catalysts create anticipation. Anticipation drives positioning. Positioning creates pressure when news exceeds expectations. Here's what I'm monitoring heading into 2026. First, quarterly earnings from sector producers. I want to see cash flow numbers reflecting the new price environment. Second, updated cost guidance. If costs remain controlled, margins explode. Third, exploration updates expanding resource footprints. Larger resources change per share valuations. Fourth, corporate actions. Mergers, asset sales, joint ventures, buybacks. Fifth, macro backdrop. Interest rates, currency pressures, liquidity signals. Each represents a potential trigger. Accumulate enough triggers and you get self-reinforcing trends. Now, 2 quick community items. Because this channel isn't monologue, it's building collective intelligence. 1, if you're successful, whether with silver, miners, business, freelancing, anything, share 1 lesson in comments. Even something simple like, I sized positions small and stayed patient. Your experience might prevent someone else's costly mistake. 2, if you're new, don't hesitate. Ask your question in comments. There's no shame in learning. The shame is feigning knowledge, then getting hurt. Back to silver. Zooming out, the deeper question isn't whether silver moves $3 this week. The deeper question is whether the world is entering a multi-year phase where hard assets reprice against paper. If that's the regime, then silver isn't a single trade story, it's a cycle. Cycles don't resolve weekly. They play out through fear and greed, through pullbacks and breakouts, through rotation from metal to equities to developers to explorers and back again. That's why I want you thinking ahead. If silver returns to triple digits, miners don't just rise, they get re-rated. Some will trade at valuations appearing absurd compared to today, not because markets became rational, but because markets became urgent. Urgency makes people pay any price for exposure, but winners in that environment are positioned before urgency arrives. Here's my final thought to retain. The next surprise in this market won't be metal printing new highs. The next surprise will be how quickly equity markets reprice once major earnings reports hit and cash flow becomes undeniable. If you want to be positioned correctly, you don't need to predict exact timing. You need to stay engaged, stay educated, and stay calm when markets try shaking you out. That brings us to the final request. If you're supporting this channel and want this anti-imitation campaign to succeed, I need 3 simple actions. Subscribe, comment, and share. That's it. These 3 actions make it harder for low-effort imitators to succeed and easier for original work to be rewarded. All right, everyone, take a breath, maintain perspective, respect volatility, and I'll see you in the next update, inside the WhatsApp channel, inside the members area, and right here on YouTube. That concludes this session.